The Federal Reserve surprised markets last week by delivering a larger 50 basis points rate cut, and although some assets like the US dollar took a hit, other assets like the S&P 500 reacted positively to this move. Now the question is what will happen until the second Fed rate cut. I'm Christina Marujos. With me today to look at the special report is our investment analyst, Achilleas Gervolopoulos. So Achilleas, the focus now is when the Fed will announce its second rate cut. Does the Fed tend to announce back-to-back rate cuts, and if so, of what size?
Good morning, Christina. We had a quick look at the 6 Fed easing cycles since 2000, and we noticed essentially 3 things. One is that Fed members tend to cut rates at the next scheduled meeting, so this happened 4 out of the 6 examined cycles. Second is the rate cut varied from 25 basis points in 2002, 2007 and 2019 to 100 basis points in 2020 when we had obviously the COVID outbreak. Thirdly, the time between the first and the second Fed rate cut varied significantly from just 13 days in 2020 to almost 8 months in 2002. All this means obviously that the November 7 Fed meeting is a live one, which means they could cut rates again. Of course, we have the US presidential election just 2 days before, so it will be an interesting situation. Also, the Fed has showed in the past its pure determination to act both quickly and aggressively in order to meet its dual mandate.
Well, as you correctly pointed out, historically speaking, some patterns do emerge looking at the market performance between the first and second rate cuts. Now, what could this tell investors about the outlook moving forward?
Yes, our analysis produced some interesting findings. Specifically, we saw dollar-yen, which is a bit of a popular pair this time. So dollar-yen dropped by an average of 1.5% in the last 5 easing cycles by the Fed. Of course, this performance could repeat again as the BOJ is still assumed to be hiking at some stage in 2024. Also, US Treasury yields tend to drop in the period between the first and the second rate cut by the Fed, provided, of course, which has happened in the past once, that the US administration does not embark on a essentially spending spree, which needs to be funded by issuing a lot more of bonds. Now, in terms of the other key assets like pound, dollar, the S&P 500, gold, and of course WTI prices, the situation is a bit more complicated. However, digging through the data, we found some common patterns emerging. One, in periods of distress, which was 2008 and 2020, we see these 4 key market assets to drop aggressively. For example, we saw the S&P 500 drop about 6% and 21% respectively in 2008 and 2020. In periods of more normal conditions, like the one we are enjoying now, and we saw that case repeated in 2001, 2002, 2007, 2019, these assets, for example, the S&P 500, exhibited a stronger tendency to rally.
Achilleas, thanks so much. And thank you for watching this special report here at xan.com.